I'm really happy to have Brendan Ross with me today. He is the president of Direct Lending Investments. And the reason I'm having Brendan on today is that one of the big challenges for the marketplace and for investors right now is that we're at all-time highs in the market. A lot of people, a lot smarter than me, think the market is due for a big correction. Robert Schiller just came out and spoke about it. He's a Yale educator, Nobel Prize winner, and basically we've only had three other times the market's been this high in evaluation period, according to him, and that's 1929, 2000, and 2007, which, as you know, are not great years. On top of that, we've not had a 10% correction in about 3 years, which we average one about every 18 months, and we're in finally in a period of the market which is called midterm election cycles, which typically draw down the market or market losses of about 17% on average. So I always say when politicians are talking, markets are dropping. So I'm proud to have Brendan on to talk about some alternative ways, some safe ways to not only to have some investments that can make us some yield, that are not tied to the stock or bond market, and help make us safer. So Brendan, welcome.
Thank you. Thanks for having me.
So tell me a little bit about, why would somebody want to invest in your type of investment? And tell me a little bit about a little about your background, a little bit about, why you put this fund together.
Sure. I was a reformed turnaround CEO, was looking for the next thing to do in my career, and had really come to understand how difficult it was for businesses to get money from banks. It's a real challenge, and it's been a challenge starting in the mid-'90s when increased regulatory pressure just shoved banks out of the business of making small business loans. And I thought I would both focus on that problem and also solve a problem for investor, the problem of yield. Short-term high-yield business loans are just a phenomenal way to make money because the banks aren't doing them, and it's exactly what investors would want in their portfolio.
So when you say exactly what they want, so what are they getting? So, people understand stocks, right? They understand bonds. And as a firm, our firm owns like no bonds. And I think you know that, Brendan. We've talked about we don't own any bonds because we believe they're a high-risk asset. Since 1950, from 1950 to 1980, Brendan, I don't know if you knew this, but it's great for your business, that bonds actually fell 40% on an inflation-adjusted basis. So explain to me, how this, maybe replacing a piece of a portfolio or a piece of a bond portfolio or entire piece, why would somebody want to do that with this type of investment?
Absolutely. Bonds, of course, are about lending money with the expectation that you're going to get paid back with interest. And if you lend your money to the state of California and they keep it for 10 years and you earn 2%, you don't really have a lot of vacations that you're going to be able to go on with those returns. Lending money is best done to people that are struggling to get it from other conventional ways. So I've hit on private credit as what I believe is the most attractive place to lend money. So if you're not thrilled with the idea of loaning your money to the state of California, and you're not thrilled with the idea of owning too much equities, then you have to look at private credit, which is really nothing more than lending and getting paid back. What I like about loaning to small businesses is you do it for a short period of time. So instead of lending money for 10 years, you're lending it, in the case of my fund, for 12 to 18 months. So you really know what's going on in that business today. You get a sense of how well they'll do over the next 6 to 18 months, and then you're lending based on the strength of their ability to repay you over that short period of time.
And when you're lending to these small businesses, which I love, I mean, San Diego, where I live, is 97% small business. So, I mean, I'm a small business owner. You're a small business owner, and so I'm very protective of small businesses and want to do everything I can. But, obviously, what are your credit constraints? What are the ways that you help mitigate risk in the portfolio to make sure that, we don't have losses in the portfolio?
Absolutely. We're looking for businesses that have been around a little while. So small business does not mean startup. Unfortunately, startups can't be a part of the portfolio. My average borrower has been in business for 12 years. My average borrower is 51 years old and is making a personal guarantee against their personal assets. And also, in addition, we'll have a pretty strong FICO score, a prime credit score of 680 or north. So what you want to do is you want to find businesses that have been around, that are owned by somebody who's been responsible with their personal credit, and then are earning some money. My average business will have revenue of between $500,000 and $5 million.
And you also have what's very unique, and I don't want to get too technical, Brennan, but you also have, as I know, what's called a UCC-1 filing against the company. Explain to our listeners what that means to them relative to controlling risk when you lend money to an individual business.
Sure. We're looking for businesses that are going to be successful, but even if they use our capital and things don't work out, they build an awning and the new diners don't come, or they expand their dental office with a lot of dentists and more patients don't come. We want to know that their existing business is still going to be able to pay us back. And to ensure that the business owner will be committed to paying the loan back, we file a lien, or what can become a lien, against their business, which is called the Uniform Commercial Code filing, so that we actually would own the assets of the business in the event that the borrower failed to pay. Now, that doesn't mean that we actually want to get into the dental business, but it puts pressure on the business owner to understand the seriousness of the transaction. When we lend money, it's with the intent of getting paid back. We don't want to be in the business of taking over dental offices or suing to extract personal guarantees, but we do pursue those when we need to ensure that the portfolio remains robust.
So what is the risk to a client in this type of investment, relative to their principal capital? What are the risk parameters that if I was going to invest in this, what would I be looking at?
The fund has gotten much bigger. We're at about $63 million today, and we own about 2,000 loans. We buy a few hundred loans every month. So the risk has gone down considerably from where it was in 2012 or 2013. At this point, we have a fairly predictable number of defaults each month, which is to say that we know that some of these loans will not be successful. It's just that we've bounded that. We know 10 loans will fail, maybe 8, maybe 12. When the number bounces up and down, that's when you see our portfolio returns change. And one of the things that you've noticed, we've been working together for some time, is that the portfolio returns don't change much. When you loan money and get paid back and you have diversification, what you don't see is much volatility.
So you have, and I've noticed that. I mean, the returns have been really steady, and I understand corporate credit and UCC-1s, and I've had a lot of experience in that, and that's what made me comfortable, Brendan, with you when we first met a while back. But explain, so the default ratios, I think that they run about 5%. Is that about right? That you have about a 5% default rate per month or per year?
That's right. It's 5% per year, which is a little less than 0.5% per month.
And your average loan size in your 60 million plus is around 50,000. Is it that? Is it still even a little lower, isn't it?
You know what? They start off at 50,000, but they become smaller. We don't do what are called balloon loans. Our loans amortize. Like a mortgage, during the course of the loan, the borrower will actually pay back principal. So what we're doing is we're actually taking risk off the table over time. So by the time the borrower is halfway through the loan, they only owe us about half.
So what is so if you have a portfolio of 60, I mean, I can do the math, but you have a $60 million portfolio, average loan size, let's say, is less than 50,000. So you have how many loans right on the books right now, approximately?
It's about 2,000 right now. We'll cross the 2,000 mark.
Okay. So what you're telling me is you have small, so you basically have over 2,000 loans, which is highly diversified, obviously. You're being paid back within 6 to 12 months on a daily or weekly basis. You have a minimum FICO credit score of 680. Your average years in business is about 12 years. And so why would somebody want to do this? What type of expectation of rate of return? And I know we got to be careful because we want to be more general than specific. Although I know how you've performed for us. as one of our managers or portfolio managers, but what would a client expect to return on this type of investment?
So our historical returns have been 11 to 13%. We're audited by BDO, of course. And I don't, as a manager, as you said, I do have to be careful about predicting the future, but my expectation is that the portfolio will perform similarly to how it has in the past. We're really loaning money for very short periods of time and getting paid back very quickly. That is not a business that changes much if you don't change who you loan to. And there are a lot of small businesses out there that need capital.
Exactly. There was a great article that, and if you have interest in this, please give me a call at 877-406-2255, 877-406-2255. Again, that's 877-406-2255, or reach out to me on the web at reyesplan.com. That's reyesplan.com. We're here with Brendan Ross, again, the president of Direct Lending Investments. So what you're telling me is that basically I can have a higher yield rate of return. Well, one of the questions is there any interest rate or inflation risk built into this portfolio? Is there any issue relative to like what a bond risk would have to your investment?
There really isn't, and that's because we keep duration short. So duration is just a fancy word for the length of the loan. So
Correct.
If you give money to the state of California and California pays it back in 10 years, you're going to have a lot of inflation risk. If you give money to a small business and get it back in a year, if interest rates change, the next time you make a loan, you make it at that new higher rate. So there's very, very little inflation risk. We're kind of avoiding inflation risk. We're avoiding local governments becoming even worse risk. And we're avoiding stock market risk. Private credit is good at avoiding the bad things that people don't like to have happen in their portfolios.
Well, it just sounds like it's a great diversifier, which is the way we use it, to a portfolio to basically, increase yield, decrease your risk to both the stock and bond market, decrease your risk to inflation, and interest rate risk. And so, it sounds like a great alternative. I mean, if you're looking at, even corporate bonds in the 4% range, which are way overvalued, high yield bonds specifically, and then you've got 10-year treasuries in the 2.5% range. You got muni bonds, which you got to hold, a lot of these times for 10 plus years, sometimes 20 in the 2.5 range. I mean, it's pretty hard to not at least explore an investment where you can be in really short-term loans, not being out, 10 years like a 10-year treasury or 20-year municipal, but being in a 6 to 12 month type of investment and earn potentially double-digit returns. Is that a fair statement?
It is double-digit, unlevered returns where you keep duration short. That's the promise of private credit. I chose small business loans because small businesses overpay the most when they borrow money relative to any other borrowers in the United States. And that's really been a function of the bank decline to small businesses. And when borrowers overpay, you don't just get high current returns, you also get good downside protection.
So what would be, let's just say the sky falls and, we go through another 2008 financial crisis. What would have to be your loan loss? I know right now it's around 5%. What type of default rate would you have to have before the fund got in trouble where you were having flat or negative returns?
So if we had a 22% default rate, we would still return 100% of investor principal. So that gives you a sense of how strong small business borrowers are. And keep in mind that these borrowers have been in business 12 years. If you look at my portfolio, what you see is Main Street. It's retail stores. It's 20% medical. There's a few restaurants in there, although restaurants generally have to be much bigger than other types of business to qualify for loans.
Yeah.
There's really a cross-section of what you see when you walk down Main Street. And those types of borrowers that have been in business for 12 years are not going to default at the rate of 22%. It's just much higher than even what a 2008 caused. even in 2008 and 2009, people still got sick. People still had cavities. People still needed to put clothes on their back. Small businesses are really tough. They don't depend for their success on the price of the yen or what's happening with Chinese real estate values. It's close to home, and it's based on people buying the things that they need in their own neighborhoods.
Correct. So yeah, no, I mean it's a, you know, from my perspective as a registered investment advisory firm and a fiduciary, obviously we have to do a lot of due diligence, and I wouldn't have you here on the radio if I didn't think that it was something that was viable. But if you have interest again in this, what we're talking about short-term loans to small businesses, as opposed to looking at other types of credit, which would be municipal bonds, corporate bonds, treasury bonds, which are going to have lower yields and also longer terms. You know, if you're interested in having the potential for, you know, double-digit returns and some diversification in the portfolio, which is what we use it for, to have an investment piece that has nothing to do with the stock or bond market. So give me a call at 877-406-CALL. That's 877-406-2255, 877-406-2255. And always visit us on the web. We have a brand new website we're very proud of, and that's reyesplan.com. That's REYESPLAN.com. Now, Brendan, I know there was a great article that I read. It was awesome. It was in the Harvard Business Review that talked about, and I believe the woman who wrote it was the head of the SBA. Was that correct, or am I off on that?
Yeah, Karen Mills is the former head of the SBA that is now a lecturer at the Harvard Business School and the Harvard Kennedy School of Government. She wrote a very authoritative piece in which she went further than what other people had said about bank lending to small businesses. Not only did she note that the decline has been extraordinary, but she also flat out stated that it's not going to recover. And it's really a difficult situation that everybody has collectively found themselves in. The banks are really under the close watch of regulators, and and while we all want to feel that our banks are rock stable with respect to their balance sheets, the problem is that the regulators do not like banks lending money to service businesses. And America is full of service businesses. And so as a result, we have a situation in which bank lending declines, alternative lending increases. Of course, the rates are going to be higher, and that's part of the process that I'm feeding, earning the higher returns that we can get because the banks are absent.
So again, if you're interested in receiving more information from me on this investment that we use for our clients in certain situations, you can give me a call at 877-406-CALL. That's 877-406-2255. So Brendan, what are your final thoughts, and what would you like to finish up on this interview? And I'm so glad we got to have you on and talk. I'm always seeking and do a lot of due diligence, as you know, and we've discussed on, you know, different types of strategies that can protect my clients, not only from, you know, the market, but the bond market as well, because I believe not only the stock and the bond market, but the bond market are in definitely precarious situations on a forward basis. So wrapping up, what would be your final piece of information or advice?
You know, you and I have always been on the same page about the fears we have about many of the traditional investments that people find themselves owning a little too much of. And I think one of the things that I've noticed is that people have a sense that when their portfolio doesn't quite match with what it is that they'd want it to have. And one of the things I like about private credit is it's so straightforward. We're lending money and we're getting paid back. To me, that has always felt like the kind of thing that belongs in someone's portfolio. And I think when people own it, that they get a real comfort and satisfaction, not just from the fact that they are doing some good and earning high returns, but also from the fact that it feels like the right kind of thing for them to be doing with their money. And we sometimes forget in the complexity of today's financial system that you can actually do something as simple as lend money and get paid back. And it turns out that it's one of the best types of investments you can make.
Yeah, and dealing with you for quite a while now. I mean, it's a something that we use quite commonly for our clients' portfolios. So Brennan, I will thank you again for this call, and we want to have you on again. And we may even have a workshop with some of our clients out here with you in San Diego. I know you're close by, so that hopefully won't be too much of an issue. Again, thanks for being on. This was Brendan Ross, and I look forward to talking with you soon. All right, take care. So again, if you want to, if you're interested in this short-term credit investment that we're talking about, where we're actually lending to small business, something I did a ton of research on before I put my clients in, and as a fiduciary in our registered investment advisory firm, we have to do quite a bit of due diligence before we do anything for clients. So if you have interest in an investment that is non-correlated or not tied to the stock market, and not tied to the bond market, that will give us yields that can be in the 8, 10, 12% range, and again, past performance is no indication of future returns, then give me a call. Again, that's 877-406. Call 877-406-2255.